Hello, hello everyone, and welcome to the Sevens Report broadcast of our August jobs report preview. Normally, the jobs report is the highlight of the month from an economic data standpoint, but this jobs report, which is going to be released Friday, September 2nd, is even more important. And the reason it's more important is because last Friday, Fed Vice Chair Stan Fisher basically said that this jobs report would decide whether the Fed hikes rates in September or not. Now, that's a potential problem for markets because right now there's only about a 25% probability priced into stocks and bonds for a Fed rate hike in September. This matters to you because if the jobs report is very strong and the expectation of a rate hike in September goes up, that's going to cause stocks and bonds to go down in the short term. So understanding what's expected from this jobs report, what will make it bearish for stocks short term, neutral, and potentially bullish for stocks short term is important because we're really at a tipping point in the bond market, and this is going to give us more color on the direction of bonds going forward. Again, we typically do what we call a Goldilocks preview for these jobs reports, and we do this for our paid subscribers. And we basically, follow the old fairy tale. There's a jobs report that's too hot. There's a jobs report that's just right, and then there's a jobs report that's too cold, and then there's a corresponding market reaction for each of those outcomes. And we give the specific levels that people need to watch, not just on the headline number. You can get that anywhere. We give the month-over-month wage numbers, which are very important, and then also the unemployment rate. That again makes the jobs number too hot, which again is generally bad for stocks and bonds, just right, which is okay, and then too cold, which is neutral to negative for stocks and bonds as well. Let's first start with what we call the way too hot scenario. And the major takeaway from the way too hot scenario is this. If we get a number or a series of numbers that is above 300,000 job ads, below 4.8 unemployment, and above 2.6 year-over-year wage increases, that will almost guarantee a rate hike in September. That will not be especially good for stocks and bonds in the short term. Now, in our full subscriber-only edition of the jobs report preview, we go through each asset class and say what we think the likely reaction of markets will be. So we go through stocks, bonds, the dollar, other currencies, gold, oil, and other commodities, so that paid subscribers, know exactly what to expect across asset classes, not just stocks, across asset classes, depending on what happens from this jobs report. This is basically the worst possible scenario for stocks, this outcome, though, because this will make a September rate hike a certainty that is not priced into stocks, and you will see bond yields go up and bonds and stocks go down if we get, again, a number above 300,000 job ads, below 4.8% unemployment rate, and above 2.6 year-over-year wage increase. Normally, we just have a too hot, too cold, and just right. Again, we started with a way too hot number because we have to clarify what would create a guaranteed rate hike in September, which is, again, is that way too hot scenario, versus what will make a rate hike in September a coin flip, a 50-50 shot. And this too hot scenario will result in September being a 50-50 shot. Above 200,000 job ads, below 5% unemployment, and above 2.5% year-over-year wage increase. Again, if we see these numbers that hit these marks, that's not going to be especially good for stocks because, as I said earlier, there's only a 25% chance of a rate hike in September priced into markets right now. If we get numbers this good, that will have to go up to 50% because it will literally be a coin flip, most likely in that FOMC room, and the markets are not priced in for that. So I'm not going to go through the individual asset class reactions because, again, we restrict that for our paid subscribers. But you can generally expect, if this is the case, for stocks to get hit, for bonds to get hit, and for interest rates to go up. Again, so this is not the best outcome if you are a bull, an equity bull. It's not as bad as the way too hot scenario, but it's not really good either. The just right scenario, this is where likely this number will fall. It's what's generally priced into stocks, and frankly, we should not see that much of a reaction. If we see anywhere between 100 to 200,000 job ads, around 5% unemployment, and 2.2% to 2.5% year-over-year wage increases, the market shouldn't really react that much because that's generally what's priced in. Stocks have sold off a little bit into this number, so you could see a bit of a reflex rally, but it's nothing that's going to create a new long-term, bull market or anything like that. This is just going to be some short-term day traders trying to scoop, a recent dip in stocks. But again, if the numbers fall into these ranges here in the just right scenario, that's par for the course, and it's not going to change the market outlook that much. Again, if you're long stocks, you're nervous about a pullback, this is the outcome that you are hoping for. This is the best case scenario for stocks going into this report on Friday. And then finally, too cold. Too cold is basically going to be anything under 100,000 jobs added, although the negative effects of a too cold number are going to be somewhat mitigated this month, and that's for two reasons. Number one, the June and July jobs report were very strong. Very, very strong numbers. So there's some room for some disappointment here. Second, August is the worst month for job ads throughout the year. It's not exactly known why. Most people think that it has to do with some sort of statistical issue with people going back to school. But when you've been watching these things for now well over a decade, like I have, August always seems to be a disappointment. It always seems to come out of left field, and people know that. So if we get a number that's really weak on Friday, people will dismiss it because it's August, to be honest. Now, I don't know whether or not that's right. We're not going to know that for another couple months, but that is generally what happens. Bigger picture, this may be a short-term okay scenario for stocks because it will remove the possibility of any rate hike in September and, frankly, probably December too, depending on what happens over the next couple months. But this isn't longer-term good for stocks. The major thing to realize in this economic data, and this can be confusing because the financial media is so obsessed with whether or not the Fed hikes rates or not, that it sort of loses the bigger picture of what is important from an economic data standpoint and from an economic standpoint, period. Better growth, an acceleration in GDP, and more demand for money and risk-taking is the key to a sustained rally in the stock market. And I'm talking about thousands of points in the Dow and hundreds of points in the S&P 500. Bad data that keeps the Fed pinned with rates to zero and says we're going to be in forever slow growth and we'll never be able to raise interest rates, that's not the formula to a sustained bull market in stocks. And I don't care what happened from a rally standpoint in the month of July. We need good growth, better corporate profits, and better earnings. That's the key. And a number that is this cold, while it won't be an indictment of the jobs market, again, we need strong data. We don't need to just very poor data and very low rates forever. The key to a sustained market, better data. So while this may provide a short-term boost for markets solely because we've sold off a little bit, and by short-term I mean a couple days or a day, this is not the number. Like this is not the key to a sustained bull market in stocks. So don't get fooled, for lack of a better word, if a number prints low like this and you hear the pundits on TV saying, oh boy, now stocks are going to rally. Not beyond a couple days, they're not. Finally, a little shameless plug here for our research product, the Sevens Report. It's a daily macro report that's delivered at 7 a.m. Every morning the market is open, so typically Monday through Friday, and can be read in 7 minutes. We provide need-to-know coverage of stocks, bonds, commodities, currencies, and economic data. What makes us different from other research publications is that we are comprehensive. We look at a full asset class, look at all the asset classes out there, and sort of put together a kaleidoscope that gives you a total picture of what's happening in the markets. And we also do it in plain English. So we are not out to try and prove how smart we are. We're out to try and explain what's happening in markets so that you can make better investments, better understand the markets, and generally feel more comfortable with the markets. We have advisors and investors that are subscribers, and the reason they subscribe, and this is based on their feedback, is because we save them time. Again, you can read our report in under 10 minutes. It will help you know more about markets, and it will, generally speaking, help you outperform. We certainly don't get everything right, but more times than not, we do pick trends that can offer some outperformance versus the S&P 500. The majority of our subscribers are advisors, but again, there are also some sophisticated investors that subscribe as well. The reason advisors subscribe to the Sevens Report is because it's a tool that helps them grow their business and get more assets under management. We give the talking points they need to discuss virtually any topic in the markets, regardless of what the client is bringing at them. And also, we help them cut through the noise of research and save them time so they can spend those hours, building relationships with clients and prospects. So yes, it is a macro research report. Yes, it does teach you about the markets, but it's also a tool advisors use to grow their business. The easiest way to see the Sevens Report, to sample it, is we have a free 2-week trial on our website. Spell it out, SEVENS report.com. It is a totally free trial. The only thing we ask you for is your email address, so we can add you to the customer rolls for 2 weeks. If after that 2-week period you don't want to buy it, you simply get removed from the customer rolls. But it's a great way to see what the report is and to see whether or not it's something that could become an asset to you in your daily routine, help you know more about markets and potentially build your business. If you want to sign up for that 2-week free trial now, you will get the full jobs report preview. Again, what you saw today is just an abbreviated version. The full version that was sent to subscribers earlier today includes the likely market reaction for all the different asset classes. So our subscribers will not be blindsided by anything that happens on Friday with this jobs report. I can guarantee that. Again, go to sevensreport.com if you'd like to start that free 2-week trial. And thank you very much for listening. And everybody have a good day and a good long Labor Day weekend. Take care.